Welcome back to The Contrarian, everybody. Today I'll be talking about the current shift that we're seeing of consolidation within the US banking system as well as in Europe as well, with regional banks increasingly seeing more outflows, some of them seeing more pressure in terms of potentially going bankrupt as well, and just the consolidation that we're seeing within large established institutional banks in the United States in particular. And all of this eventually leading to a very beneficial scenario for the Fed to actually implement their FedNow program, which would be a central bank digital currency. So today I'll be talking about this, looking at a lot of the trends having to do with this, recent developments just in the last weeks. Obviously, a lot of this was kind of up in the air, a lot harder to see just a few weeks ago, and now with Signature Bank, Silvergate Capital, Silicon Valley Bank, all of that that's happened in the last week, Credit Suisse, don't forget them. That's obviously brought a lot up recently. Yellen recently talked about how they are insuring above and beyond FDIC for all of these large banks that they deem to be essential, but they're not doing it for the regional and local banks. So there's a lot going on right now. There's some good news and some bad news. The good news is that it appears that bail-ins, which were feared, might be done this time. It appears that bail-ins aren't really going to happen. The bad news, though, is that bailouts are being done selectively, and they're being done in a irresponsible way, just as they were done last time. So moral hazard is still very much being propagated. People aren't being held accountable for bad investment decisions that they made, and so bailouts aren't going well. That they aren't being done in a good manner, and also they're being done in a selective manner. So, like I mentioned, Janet Yellen and the Treasury effectively saying that we're only going to insure above FDIC for essential banks, like they did with Signature Bank, I believe. Or Silicon Valley Bank, sorry, like they did with that bank, going above and beyond FDIC, ensuring all deposits, which, let's be honest, probably most of the depositors in Silicon Valley Bank were, startups with a few million, if not more, in capital. So $250,000 is not that much to insure for Silicon Valley Bank. There likely are a lot of political connections as well, just with the Silicon Valley startup political environment, linking that with the Fed in a more significant way. So for the Fed to say that they will suddenly insure all deposits on banks that they deem to be essential, which basically is just think large banks. Don't think small local regional banks. Think large banks that have connections, ties to the federal government, to the Federal Reserve. Those are the kinds of banks where it does appear that they will now bail out all and insure all deposits, whereas it's the small local banks that don't have that guarantee. Now, whether or not these small local banks actually have an issue is not really relevant at this point, because the incentive now for large depositors in these regional banks is to move their funds, move their capital to the large essential banks. And so that kind of shift is taking place. Yellen was actually confronted when she talked about this. A public individual, I don't know what exact title he was, maybe a representative of some kind, he brought this up to Yellen, essentially saying, yeah, you're encouraging capital to flow out of these regional banks into these more centralized institutional banks. And yeah, she effectively confirmed that that is what is going to happen. Now, Yellen is kind of an interesting figure in that it appears that it's difficult for her to tell a lie. She kind of has to tell the truth, which at times can seem kind of strange that she's telling the truth at times, when it's very much so, things that people would not want her to be saying on camera. But in other words, all roads at this point are kind of pointing to a consolidation within the US banking system. And a lot of other people out there in the last week have pointed this out. I'm definitely not the first one to say this. Now, their FedNow program is due to roll out in July of this year. That's just 4 months from now. So a lot of things could happen between now and then in terms of more bank failures, maybe a more contagion type of effect, maybe a bank runs of some kind of a more sizable scale than we have already seen. So a lot more things could happen between now and then, which would further kind of roll things down the road towards a better environment in which the CBDC could be launched. So the Fed would really be in a good position if by that time there's a lot less regional banks in existence, more capital is centralized in these large banks. I'm talking like JP Morgan, Citibank, Wells Fargo type scale. And don't forget, it was these banks and a few others who actually just late last year did a trial type run with the FedNow program. So it's kind of like the Fed was planning all along to roll out their CBDC using all of these large scale, almost nationalized banks at this point because they were bailed out in 2008. So, and who knows when they'll or if they'll be bailed out again this time. So if the Fed does roll out their CBDC with these large banks, at that point that they're kind of not entirely separate from the U.S. government. They would be sort of nationalized in a way, but nevertheless, it would provide an easy way for the Fed to roll out their CBDC, and a lot of convenience would come as well if there's a much more chaotic type of collapse in regional banks and local banks. If people are coming to the Fed, coming to their local representatives saying, we need a solution, we just lost a lot of money in our bank, or a certain bank just went under and a lot of people are just without funds all of a sudden. All of a sudden that provides a very good opportunity for the Fed to step in and present their FedNow program. Maybe they restore capital in a situation, but it's all of a sudden in a different kind of scenario. It's now in these digital dollars, which basically doesn't mean much different from what people already had in their bank accounts because no one physically had cash anyway. But it does mean that there could be a lot of controls that would be given to the Fed. So it definitely does open the doorway to the CBDC. It could be a timeline in terms of the actual utilization of all of these tools. Of course, it probably would not be as draconian as it could be right at the get-go, but of course it would progress in that way once you give tools of power to pretty much any individual. They're going to abuse that power, and so CBDC does hand the reins of quite a lot of controls to the Fed and whoever else could control the Fed. So I'm sure you're all aware of these, but the Fed could cut off funds if they don't like what you're doing. We obviously all saw that already in Canada with the trucker protest, the vaccine mandate protest that occurred about a year ago. They cut off their funds and effectively just erased their money. And that went, way above and beyond what the actual Canadian law had in place. But at that point, the law kind of becomes irrelevant because you have the federal government itself stepping in and mandating that these people cannot transact, and what supposed money they had in their accounts is suddenly gone completely, or they lose it for a while. So it's kind of scary in that sense in terms of how quickly things could go once a CBDC does come in place. Encouraging developments, I will say, are that there is now legislation in states of Florida and Texas, and hopefully others to join, that is saying that we will ban a CBDC from operating in these said states. So in theory, it could be possible for individual states to either accept or deny a CBDC, which ideally most states would come to that. Freedom-loving governors and representatives would come to this kind of realization, of course, with the push of their people. So at this point, it's really in the hands of individuals to resist this shift toward a CBDC, to resist the shift of a centralization of banking. I guess some simple things that everybody could do is to transact in cash as much as possible. I try to do it. I know it's inconvenient. It's very convenient to try to use credit cards or debit cards or whatever, but cash is really helpful, and it could be very essential when a bank does in fact go, because if you physically have your cash, it doesn't belong to the bank anymore. If you give it to them, technically doesn't belong to you anymore. You've just added it to their balance sheet. So having physical cash on hand could be a very good idea as well, especially given the current environment we're in. Yeah, gold and silver could be a good type of safe haven. They tend to also really outperform other asset classes when there's a kind of contagion or widespread panic going on. So all of that being said, I'm not trying to say what you should or should not do with your own capital, but maybe just some good ideas of trying to transact in cash. Definitely encouraging your local state representatives to not accept a CBDC, even preemptively to put in place legislation like what Florida, Texas are trying to do. That would be great to see all the other states, and most states do that. Of course, not all of them would, but it would be great to see a lot of other governors and representatives follow suit with that. So all of this being said, I like to talk about major trends developing. This is a lot more clear now that a lot of these bank collapses have happened, now that we've gotten to listen to Yellen and Powell talk about what they see coming down the road. So unfortunately, it does seem to be going this direction, but there are a lot of things that can be done at this point. So I hope you all enjoyed this video, and I hope to see all of you again at some point.